everybody. Very warm welcome to the Financial Services Council ReGenerations Reimagined conference. We're beaming into you from all across the country and delighted at this very first session that we've got absolute pleasure of hearing from Rob Everett, CEO of the Financial Markets Authority, for his last speech to the FSC community. A few things to do on the basis that if we can all imagine that we might have been in a room running a conference in a fairly traditional way, there's a little bit of welcome and ceremonial piece that we just wanted to put around this program before we get there. And so without further ado, before we get into some of the thank yous, I wanted to welcome and acknowledge Rob Flanagan, Chair of the FSC, to say a few words of welcome. Rob, over to you.
Thanks, Richard, and tēnā koutou, tēnā koutou, tēnā koutou katoa. On behalf of the FSC board, we would like to extend to everyone a very warm welcome to the Regeneration Conference. Firstly, we'd like to thank the sponsors for without their support, the conference just would not happen. And also the speakers, which there are many, a big thank you. I'd also like to give a big thank you to the FSC team and the conference committee for their work in organising the conference, running several scenarios depending on which way COVID-19 was going to affect us requires a considerable amount of work, emotion and open-mindedness. This they have done with passion and professionalism, and I'm sure over the next few weeks we'll all obtain the rewards from this. A big thank you from all of us for this work. Today I'd also like to welcome Rob Everett, Chief Executive of the FMA, and I suspect this is perhaps the last time we'll have the opportunity to formally say thank you and to wish you well in your new adventures as you finish up with the FMA at the end of the month. There are many ways we can have a relationship with a regulator. Is he a policeman? Is he someone to avoid? Should we be defensive, keep him at a distance, wait to be told, and so it goes on. The relationship is not determined by the position, it is determined by the values of the person in the role. Rob, to us within the FFC, you have been a real professional in every aspect of the work. Over the past 7 odd years, which I believe has been an historical correction point for the financial services industry, as the industry has not kept pace with the changing social needs and expectations, and a reset was required. Rob and his team have engaged with the FSC continually and consistently, and as a result, we've come a long way, but still a way to go. I personally appreciate the engagement and many of our private calls where we've had some adult conversations. I've appreciated this, and it has enabled us to have greater depth of understanding of where each of the parties are coming from. You leave the FMA at the end of a phase with strong foundations for new regulations being implemented in the next few years. You leave your position with the respect of the industry. A very senior civil servant once said to me, as a civil servant, all one can expect is you come into a job at a point in time. There are so many different stakeholders, from politicians through to consumers, all of whom have agendas. And if you look back and say that you've taken an organisation from a point to a much better point, you can say you've done a good job. Rob, you have done more than that. You've added considerable value in respect to the FMA. You've taken and influenced the industry to step up, to be much more consumer focused, and as a result, everyone is better off. You've done a great job, and we thank you for that, and wish you and your family all the best in the future. I'll hand over to Richard to get the conference underway. Thank you.
Thank you, Rob Flanagan. Just a couple of brief opening comments just to Rob Flanagan's point. A huge thank you to so many different parts of the sector, but in particular to our sponsors who we'll see in a moment, and to our conference committee. It has now for the second year been a pretty tough task to create and prepare a program that was designed to be in person, and now for the second year to pivot and to go online into digital formats. Takes a huge amount of resilience, courage, and just sticking at it to get to the point where you can do that. So on behalf of all of the people in the FSC Conference Committee, please take a bow. To our sponsors, and if we can just perhaps put the slide up, just wanted to acknowledge that commercial activities like this only take place because of significant and generous contributions from right around the sector. And I did want to acknowledge and thank all of our sponsors for, again, joining us on this journey as we've gone from face-to-face to online and hopefully back to face-to-face, COVID permitting. Of course, we are sitting here in Auckland. Some of us are in Wellington, and those at the other end of the line are all across New Zealand. So everyone finds themselves in a slightly different place and perspective vis-a-vis COVID. But one thing to say, it has been a pretty challenging couple of years. And irrespective of where you are, I think the way in which the sector's held together, stayed together, and continued to focus on serving their clients whilst moving online has been really, really excellent to see. Folks, with that, I might get us back into the standard view, Hayley, and wanted to acknowledge for this particular session our sponsor, which is Chapman Tripp. We'll hear a little later on from Tim later, but really this session is all about Rob Everett and really his views, reflections, past, present and future of his time in the FMA. So Rob needs really no introduction to all of us. Echoing Rob Flanagan's comments, it's been an absolute pleasure to work together. And with that, Rob Everett, a very warm welcome to what I think will probably be your last time in this role on this platform. And the floor's yours, so thank you.
Thank you very much, Rob and Richard, and thank you, Rob, for your kind words. Good afternoon, everyone. Enya mana, enya waka, enya reo, e rao rangatira ma, tena koutou katoa. So as Richard has said, I have been asked to reflect both on the past 7 or 8 years in the role and also what lies ahead. And as you've heard from both Rob and Richard, I had written a speech, obviously, assuming I had a captive audience in a room where sleeping, playing darts, personal grooming and wandering off to make a cup of tea weren't an option. So to keep your attention, this is the abridged version of the words I had written, but we will publish the full version today. So when I arrived at the FMA, the FMC Act was just a few months old, and we were a few months away from the first wave of licensing under the FMC Act, which was crowdfunding and peer-to-peer platforms. The FMA was busy with what we thought at the time was the very end of the court proceedings and investigations that came out of the finance company collapses. And the FMA was preparing itself and the industry for licensing and conduct regulation under the Act. So here now in 2021, the FMC Act is fully operative. The financial advice regime has already been substantially revised from what it was when I joined. And we are facing into major changes to our mandate with banking and insurance regulation and climate-related disclosures and some other pieces beyond. So thinking back to early 2014, what did I ask of the financial services industry? And I thought I would repeat a couple of passages from my very first speech as CEO of the FMA at the time. And I asked the question then, what do I ask of industry leaders? I ask that you embed the concepts of interests of the customer and integrity in all that you and your organizations do. These must be the very cornerstones of the industry. And in relation to our focus on culture and governance, I went on to say, we will be demanding of the industry in ways that you have not seen before. We will ask, what behaviors do you model? Who do you reward? How do you motivate and incentivize? What behavior do you punish? I said that culture within firms was critical and it needed to manifest itself in all core processes that drive customer and regulatory outcomes. So I repeat all of that to show that under my tenure, we have been consistent in what we've asked for from the industry, and I think pretty clear. A couple of years later, in late 2016, early 2017, we put some flesh on those bones and issued our conduct guide. And whilst at the time we only had licensing authority over certain sectors of the industry, we expressed the hope that other sectors would take note and start changing their operating setups. Quite frankly, I'm not sure we've really seen that. It took the Royal Commission in Australia and our conduct and culture reviews with the Reserve Bank to get some parts of the industry to take note. And even now, it is requiring court proceedings and public sanctions to bring some firms fully to the conduct table. We have asked for and received more financial ammunition from the government to bring complex cases which may be resisted stoutly by well-resourced firms. And that is what we have been doing. Conduct regulation is complex. At a high level, everyone on this call wants fairness, transparency, integrity. There will always be crooks, fraudsters, and outliers, but I believe the bulk of the industry wants and aims for those same things. And so at a high level, it may sound easy. But as you all know, financial services is a collection of very different sectors that interact and interrelate in complex ways. And behavior or outcomes that in one set of circumstances seem unfair and reprehensible, in another can be seen as unfortunate but reasonable. And as ever with high-level principles, what seems obvious and free from doubt to me as a regulator may not seem obvious and free from doubt to you. And it certainly won't when some lawyers have got hold of it. The days of long-standing black and white prescriptive legislation are probably over in lots of areas. And that approach was never going to do the job for conduct regulation. The legislation now needs to give us the skeleton of the requirements and expectations of lawmakers, and regulators in the industry need to work together to frame what practices and processes, what governance and culture will deliver those expectations. And where regulators and firms cannot agree, the court will need to assess the particular circumstances and make its judgment. That is principles-based regulation. So where are we on that conduct journey? So I was asked back in 2014, what was the biggest risk I saw to the conduct regime for financial services that was being built in New Zealand? And I said complacency. So I came from the UK, where the systemic meltdown of the financial crisis was followed by ugly revelations of poor sales practices and institutionalized dishonesty. I was genuinely surprised when I got here to hear some senior people in the industry tell me that I didn't need to look at the big end of town. I should focus instead on the operators lurking around the edges. Why look at us? We're regulated half to death by ASIC and APRA already, said one big bank CEO to me. Well, you don't get much bigger in the UK than Lloyds Bank or globally than UBS or Wells Fargo. But the damage done to confidence in financial services by those firms, confidence that markets or customers will be honestly or fairly treated, has been colossal. And I'm not at all convinced that the industry as a whole, or those in the legal and consulting professions that advise them, paid that much attention to my comments on arrival, or the conduct guide in early 2017. As many of you will know, I'm a big believer in buy-in, in getting industry buy-in for the direction of travel. But where we don't get that buy-in, we will continue to use the stick, enforcement action and public censure. If you look at our current slate of activity at the FMA, that is, or certainly the activity that's visible to the public eye, you can see that we've been active on money laundering, derivatives for retail investors, insurance products, KiwiSaver, and a host of other areas. So it was clear to me back then that the conduct journey would be hard yards and it would take a good while. And I reckon we are no more than halfway. So what lies ahead? I'm thinking about legislative change and remit change for the FMA in particular. And I'm disappointed as a self-indulgent response to be leaving this role before the Kofi bill becomes law. That draft legislation was the direct result of the conduct and culture reviews that we undertook with the Reserve Bank to try and get some degree of assessment as to whether the Australian bonfire could happen here. And bear in mind at the time, the FMA licensed those bits of banking that undertook financial advice or funds management, but really not much else, and nothing really in insurance. So our line of sight and arguably influence over the true state of play from a conduct perspective was pretty thin. I regard that draft legislation as the plugging of an industry-sized hole. In fact, two industry-sized holes in New Zealand's conduct regulation. The FMC Act as drafted reflected its predecessor legislation, so the Securities Act, Securities Markets Act, was focused on investment markets, investment products, investment advice. It left out the vast swathes of New Zealanders who interact with financial services through their bank products and their insurance. And we've seen with financial advice, for instance, the benefits of a code of conduct for what was then the authorized financial advisor population. And that's a segment of the advice sector that we think has set standards for the rest of financial services. We've seen how banks responded to the culture and conduct reviews and to our attack on misaligned incentives as we saw them. And that with the right leadership at the top of those organizations, even the biggest end of town can turn itself around relatively quickly. And I'll repeat here what I said then. I do not believe that the egregious misconduct that we saw in Australia under the Royal Commission is endemic or systemic here. But it could be. And even if it isn't, we do see some sloppiness, lack of resource, and conflicted behavior across the industry. A critical lesson for management and boards of regulated financial services firms is that where we see accidental harm or even risk of harm to consumers or investors, we will take action. The fact that issues we see are not deliberate is relevant, but is in no way sufficient to get you off the hook. Investing in good technology, creating and maintaining effective processes and rigorous disciplines is hard work, but it is what is required and it is expected. And similarly, going back and scrubbing products, legacy products, systems, practices to see if they are what they were supposed to be, or whether they no longer work as well, perhaps, as they once did for customers. That is painful and expensive work, but it needs to be done. And where there are issues, they need to be promptly dealt with and promptly disclosed to and discussed with regulators. We are, however, seeing good signs of progress in almost every corner of the sectors that we regulate. Remediation programs are getting better at identifying and resolving past issues, and product design and marketing, while still occasionally seeming as if it serves the provider better than the consumer, has started to shift. We also see advisors, insurers, fund managers, and banks striving to serve customers in times of need, such as the last 18 months, and working hard to meet our expectations and their customers' expectations, and to help us hone those expectations so that they're demanding, appropriately demanding, but also fair and reasonable. So the FMA will be here long after I'm gone to engage with you, listen to you, and offer support wherever we can. I'm a strong believer in agreeing a common purpose and an end objective being the very first thing that needed to be done in this area, and that this is now in place. A word here for the Financial Services Council and the many of you on this call who contribute selflessly to its work. I do know that many of you toiled long and hard to get the FSC and the industry sectors it comprises to where we are today. I take my hat off to all of you. I know this stuff is almost always additional to your day job and rarely rewarded, and that it requires a real passion for the professions that you all want to be part of. I recognise the achievements of the FSC, the quality of its research and its investor and consumer materials, and the leadership shown by those at the top of the firms that are driving it. Thank you to, and in particular to Rob and Richard. You have my admiration for the job you have done and the battles you have fought, including with me, to get here. And so to conclude this slightly abridged version, I'm going to go back to one of my favourite themes, and that's to point to leadership. This industry will flourish in New Zealand if it remembers who it serves. That is every man, woman, and child in New Zealand. If you work in financial services, you provide vital products and services to New Zealanders. Advice, insurance, banking, managed funds, investment products and platforms. Our economy cannot thrive without confidence that financial products and investments are offered and sold honestly and fairly. So at the FMA, we are here to help you be proud of what you do. And if leaders at the top of the firms never forget that sense of service and resist the urge to take the simpler or more profitable route rather than the harder and longer term routes, then the industry sectors represented here on this call will do great things. I have been honoured to serve you and all New Zealanders in this role. I'm really proud to be handing a strong and experienced leadership team at the FMA to the next CE. I want to thank you for your patience and your commitment. It's been a privilege. Thank you.
Thank you very much, Rob, and appreciate those comments and those insights. What we're going to do now is, if you will, have the fireside chat across the internet, if we can, and to the people on the other end watching, it is as interactive as you want to make it. So within both the Attendify and the Zoom platform, there's certainly great opportunity for Q&A and chat, and absolutely encourage you to participate in the discussion. Rob, I might just open, if I can, with this conversation around consumers, because in the end, this sector is really here for one purpose, and that's to serve the people who consume the products that our sector manufactures. And it seems like there's been a lot of discussion over the last couple of years about consumers, and we've seen lots of changes taking place through COVID. I mean, how do you think consumer behaviour is evolving and morphing in terms of A, how they interact with the sector, but B, also some of the changes that are coming through a la technology-driven platforms and so on?
Yeah, it's a really good question, and I like to split this somewhat artificially into what I described as our kind of starting remit, which is about investors, and the piece that really is coming to the fore for us in the Kofi bill, which is consumers. But they are all, in the end, consumers of financial services. So, very testing period, for everybody, industry, regulators, and consumers and investors over the last 18 months in particular. We have been blessed with a long bull market and a pretty robust economy up to this point. Look, I think our experience so far through the industry feedback that we get and the consumer feedback we get is that this latest series of lockdowns, latest lockdown, shows that consumers are actually feeling more resilient than perhaps when COVID first struck. Investors too, albeit we haven't had the market turmoil we had last March and April that did spook some people. We've seen less anxiety about financial products, less volumes into call centres, less queries into us. Now, some of that may change as financial circumstances deteriorate as lockdown continues. But we think some lessons have been learned by investors in particular, but also consumers, not to overreact. We think the efforts that the industry's made to recognise that in times of trouble, people want to speak to their provider, and they're not necessarily going to wade through a bunch of terms and conditions. A lot of people want to get on the phone and have a voice at the end. And we saw the industry respond heroically to that last time around, but struggle to get people trained up quick enough. This time we haven't seen the volume, but I think that's because comfort levels have been better. So, look, I think the response has been pretty resilient. But to be fair, we haven't had the economic meltdown that we perhaps feared, although I accept that times are very challenging for a lot of businesses, and the markets have continued to go up. So I don't think we've been fully tested yet. So we should be ready for that.
Yeah, Rob, were you surprised? If we go back to that March, April of last year, were you surprised? As people ran for the hills and cashed out, or some did, in terms of the behaviour or the kind of fear-based response on one hand, and for others, completely not. They kind of held the line and then obviously benefited.
Yeah, look, to be really honest, I wasn't surprised by the knee-jerk reaction. It's an entirely natural human reaction, and quite frankly, things looked pretty grim for a bit. So no, we weren't surprised. In fact, in hindsight, we're probably surprised that more people didn't switch in KiwiSaver, for instance, or pile out of investments. I like to think that was helped by a consistent line from the industry, from advisors, from KiwiSaver providers, from fundies, from the regulators, that overreacting, particularly for a long-term product like KiwiSaver, was the wrong thing to do. And I like to think that the experience since, which was of a very rapid and marked bounce back, which actually left some people adrift, would have taught people a lesson for the next time, but my experience is that those lessons only get remembered for a short period. So I'm not wholly confident, but no, not surprised. But I think it was a growing up lesson. There's a growing up sort of pain, if you like, for people in KiwiSaver, and I think it did trigger some of the renewed interest in both KiwiSaver and retail managed funds as a product, but also investing in markets as a whole that we've seen subsequently.
Yeah, I'm going to come back to that, but just that question around overall resilience. The FSC ended up doing the Financial Resilience Index, which tracks stuff over last year and this year, and it was remarkably resilient. And that wasn't where we thought we'd start. Does that surprise you?
Well, as I say, I think I think things have been resilient, but that research you refer to, one of the scary things for me, which I think is actually not inconsistent with research in some other countries, is just how close a lot of people are to significant vulnerability as in the context of their financial circumstances. And I think that's something we all need to remember. So with KiwiSaver, which is a long-term product, it may be relatively straightforward to try and remind people that you're in here for the long term. It's really a retirement product. In some of the more consumer finance areas that we're looking at now, banking and insurance, credit, it was very striking how close significant portions of the population are to getting in real trouble. And I think when you have a COVID pandemic like this one, or we potentially have other reasons for economic turmoil, it was a reminder that although I think people have responded well this time around, and I'm impressed by the levels of resilience shown, I can see that the ice is very thin for a lot of people. And I think it's something that the broader industry as a whole, I hope that's something that has hit home, and that we all realize that a lot of people are really only one piece of bad news away from really struggling.
Yeah. The data on that front was pretty compelling. There was something like after 3 months without income, there would be serious struggle. And yet, on the other hand, we've seen asset prices boom, flows into retail funds boom, obviously interest rate at record historic lows. So there's obviously something else going on that's kind of cushioning that. But I think that it's not far below the surface, is it? That the difference between resilience.
I think for those who have money, it's been a great last decade because you've probably made more money. But thinking about our banking and insurance mandate ahead of us, I think it is important for all the financial services to remember that there are sizable segments of the population that frankly don't have money and are very, very reliant on their financial services providers.
Yeah. Rob, can I just pick up this theme that's been evolving? The FMA is such a trusted brand in the marketplace, and there seems to be a much greater sense of the FMA's role to help educate and guide consumers. Can you kind of just take us through that in terms of where it's heading, and how do you see the sector effectively playing together with yourselves, the CFFC, and so forth?
Yeah, that's a great question, and I think it for me reflects some of the growth in confidence, within the FMA as we've grown into our mandate and we feel more confident in the areas in which we operate. We asked ourselves over the last 7 years the hard question of, how many New Zealanders know who we are, and bearing in mind that usually came in at about 40%. Was that a good thing? Was it a bad thing? Was it a problem? What's a good mark? Were we the right people to be speaking to consumers about education about financial products and the rest of it? And we had a lot on, and so there was probably a lack of confidence for us that we had the bandwidth or the capability to be relevant to consumers. So we tended to work through those who already had the links, CFFC through Sorted and through the providers themselves, actually. But I think what you've seen as we contemplate the Kofi bill, banking and insurance, is that in the sectors we're already in, so the investment sectors and in some of the consumer stuff, a willingness to actually put ourselves out there a bit more, and to try to be seen as a objective and moderate educational voice, if you want to use that terminology, to help build capability. But I've always said that what's really critical there is that we have to do that jointly with the providers, because the providers have a direct line to their customers. A lot of those customers either won't know who the FMA are or don't really want to hear from a regulator. So, in a lot of our discussions with firms, we've talked about either us providing material or firms providing us the way to get to their customers. We did some great stuff with Sharesies recently, where we got to do a survey for their customers. And the co-design here is really critical. So we know that we cannot on our own educate the population, either for investment products or for financial products generally, on our own. And that the industry has a responsibility to be doing that. So if we can work together to have consistent approaches where possible, and frankly use each other's materials, we have a better chance of reaching people, and that's really what's key. So look, I'm a huge believer in the FMA having a voice in this space, but it's a voice that won't be heard by everybody, and we just need to work with the providers and some of the consumer bodies that we're working with, particularly as our remit broadens, to find a way of reaching those bits of the population that don't spend their time Googling FMA or Rob Everett.
Yeah, there's a lot of really good collaborative stuff I know in the pipeline in that regard. Just last one on the consumer change piece. Both the FSC and the FMA did research, and you just mentioned Sharesies on the rise of digital platforms and how people actually accessing markets. Is your sense this is the revolution's here and it's kind of changed the game forever? Yeah, and we did some research too. No, I do. I honestly think what we've seen in the last 18 months in particular, given a turbo boost by, people being locked down at home, by probably not being able to spend as much money, low interest rates, high house prices, you name it, technology. We're way past the tipping point now. And so people investing or buying other financial products online on a mobile phone, influenced by social media and chat rooms in some cases, it's here and it's happening. Some of the more extreme stuff we saw in the States with the GameStop phenomenon and the rest of it, we have seen less of in New Zealand. And in fact, the people using platforms like Sharesies and Hatch and Invest Now, largely speaking, seem to be doing so for buy and hold, on a buy and hold basis and a longer term basis, which is great. But there are people who haven't been in those markets before, who may not know how to react in a crisis, who may just be having a bit of fun, but it may be a gateway for them actually to a broader interaction with investment products in particular. That's certainly my hope. And, if you talk to all of those platforms, they're all building their managed fund sort of product because of exactly that. If you go in and have a bit of a dabble with Tesla and GameStop and the rest of it, you may realize that at some point you need to be in seriously, and actually probably you need to be letting someone else do the stock picking and hand yourself to a professional. So it has changed everything, and it's got challenges in terms of how those platforms are designed, what behaviors they're trying to trigger, the so-called gamification, that the US regulators have worried about with Robinhood and the rest of it. But it can be an enormous force for good. Those people who aren't going to look at the FMA website, they will go on a Sharesies website, and that's great. So if we can influence Sharesies to be putting the sort of stuff up there that we think is balanced and moderate and helpful, and occasionally even our own stuff, that's a great channel. And so, I look at that for the industry. Ease of use is a brilliant thing when it's used well. It's a dangerous thing if it doesn't carefully consider how people will interact, with a mobile phone on a bus, for instance. Yeah, and there's some regulatory perimeter challenges around how fast it's moving in terms of where regulation is at as a sector, or as a growing sector.
Yeah. Well, I'm always saying that legislation never keeps up with reality. None more so than today. And if you look at those trading platforms, investment platforms, you look at cryptocurrency platforms, it's always going to go quicker than regulation can keep up. And I'm sure most people listening to this, the last thing they want to hear me say is that we should change legislation again. So we have to work with what we've got. We have a great relationship actually with all of those trading platforms. And yeah, the bite that we have, where we don't license those platforms and we don't have a supervisory relationship the way we do with the license firms, means that our relationship will be different. But we like to think we can still be an influence, and hopefully an influence for the good. And we're certainly paying a lot of attention to what's happening in that space. So yeah, the regulatory boundaries, only do so much. But again, I think a sign of the FMA's confidence, I hope, is that we feel less constrained by precisely what the legislation indicates, should be our areas of influence than perhaps we once were. And a constructive dialogue with those corners of the industry that are just outside the license perimeter, is still worth having.
Great. Rob, I might just change themes from consumer to that leadership and governance and boards theme that you touched on in your speech. And there's obviously a bit of a review going on right now with the Reserve Bank as well. I mean, what's your sense of the progress that boards and governance models overall have made, lessons learned from the Royal Commission Conduct and Culture Review? How much progress are you seeing?
Well, we're definitely seeing progress. I think boards have a tough gig in that, particularly in a complex financial services firm, there's a limit to what the directors can see as to what's going on and what they can influence. But, the signalling from boards has changed, certainly in the time I've been in the job. Not necessarily that the FMA should take any credit. I suspect the Royal Commission was really the game changer. From occasionally having it on the board agenda to actually meaningfully interrogating the data and asking for the data and trying to understand, what is a good customer outcome? What is a fair customer outcome? What data have we got that tells us how that works? So we are seeing a real shift, but there are still parts of the financial services industry, particularly the bits that aren't yet licensed by us, where understanding how to operationalize what the boards are expecting or asking, hasn't developed as quickly as you would have hoped. In some cases, that's resource constraints, and everyone is very busy with a whole bunch of regulatory change. In some cases, I think it's a lack of understanding of just how hard this is and how much resource needs to be put to it. So I think boards' focus of attention has certainly shifted. I think, though, that it's still easy to underestimate just how difficult it is to rewire an organization. I think Rob may have kind of used that terminology in the start about, resetting bits of financial services. Good intention is not enough. You've actually got to have processes and systems that deliver those good intentions. And I think, where we're rubbing up against some parts of the industry at the moment is that, as I said in my prepared remarks, the fact it's inadvertent and accidental, noted, but by no means is going to get you off the hook. And I think the learning is you have to start early with operationalizing that stuff. And when the Kofi bill comes into law, our view there will have been a long lead time for firms to get ready. And, we're going to continue to put out guidance and we'll refresh the conduct stuff at some point. We expect people to have got most of the way there by the time they get licensed. And so, we have issued a bit of a hurry up in some parts.
Because it's a pretty powerful motivator, isn't it? The reputation, the reputational piece, particularly around, some of the recent actions over the last 6-12 months. I mean, that's very galvanizing for an organization, isn't it?
Yeah, well, I certainly hope so. I mean, one of the debates we have as a regulator is that given the pushback we get, we know that a public comment from the FMA, public warning or a censure, that's generally taken very seriously by boards of licensed entities. And we know how much firms like to avoid that if they possibly can. So I'd like to think we use that judiciously. Sometimes, the media in particular feel that it's a bit of a wet bus ticket, and if you're not actually in a courtroom or got a court sanction at the end of it, there's no impact. But, we have to size our regulatory responses to what we're trying to achieve and how quickly. And I hope that the reputation of the firms, the boards and management continues to be precious to them in trying to make sure that the right thing gets done.
How difficult has it been, this kind of tension between a conduct regulator on the one hand and an enforcement regulator on the other, particularly when you're deciding about, the carrot versus stick approach across different parts of the sector?
Yeah. Well, you have to have both. I'm as you all know, I think, I like to persuade people that the direction of travel that we want is the right direction and everyone should go in it. But my powers of persuasion are probably relatively limited if you don't have the stick of enforcement and a properly funded enforcement budget and a bunch of litigators who enjoy testing themselves in court. So, we will use the courts where we see fit. We will use public censure and sanctions where we see fit. But, it's a complex balance, as you say. We're trying to incentivize and encourage the industry to move in the directions we want them to. And that requires occasionally some patience or, taking a whole bunch of things into account. But it is critical that the industry knows, particularly the big end of town, which is better resourced and probably more willing to get in a fight, knows that we won't give up if someone keeps pushing back. And I think we've got a track record now of not giving up where we feel we need to keep going, and if expensive, lengthy court time is required, we're up for that. So it is both, and people need to believe that where we see it to be appropriate to go the enforcement route, we're willing to do so. But I'm very hesitant to have enforcement drive the behaviours entirely, because I don't think you get long-term buy-in that way. I think the industry needs to agree with the direction of travel as a first up, and enforcement is just a tool to keep people on the straight and narrow.
Great. Hey, I'm just going to go to a couple of questions that have come in, and then a couple other themes, noting that we're at 4:13. Just question here is, what are you most proud of as you kind of about to exit the role? What's the thing that you're most proud of?
Well, not that I should necessarily take credit for this, but I think it would be that piece I was talking about earlier about the confidence to operate sort of outside the clear bounds of the licensing framework or the legislation. If you look at the conduct and culture reviews, a couple of years before that, we would never have done that piece of work. We would have looked at it and said, we don't license the banks, we don't license insurers, we don't have much real insight into what's happening, away from the bits that we do license. Someone else should do that, or we might have said, too hard. But thanks to Adrian at the Reserve Bank being such an enthusiastic partner, we decided that even though it was slightly out of our zone, that it was really critical for the sake of confidence in financial services to go and do those reviews and to address any gaps that we saw afterwards. And likewise with some of the stuff we've been doing more recently that's more educative and more aimed at the end user, I think it's a sign of confidence in the job that we've got and our ability to do it well. And I think, that's just a question of growing up. It's a question of experience. It's a question of understanding the industry a bit better. And it's a question of capability. If you look at my top team, I've built that out and broadened that out over the last few years. And we're firing on all cylinders, I think, at the moment on a whole range of fronts. So, yeah, that growth and maturity, I think, would be the thing that I would note most that's different to perhaps when I arrived, when we still felt like a startup.
Yeah. Just picking a segue there into the Reserve Bank and Adrian and COFA, it seems like the regulators sitting around the COFA table are much more aligned in terms of an engagement strategy. It feels like on our side. I mean, how do you think COFA will kind of play out over the next little while, and how does COFA make trade-offs about what things to go after versus other things that might not?
Yeah, Yeah, and in the longer version of the speech, which will be published, there is a little piece there about the need for the COFA members, but actually all of the government agencies to be more collaborative, or continue to be more collaborative, and really focus on creating a coherent setup for the financial services industry to be regulated by. So look, it's changed again beyond recognition from when I arrived. That's partly personality, but it's partly a recognition from the government as a whole that, if we're all going to play in the same space, if you've got Comcom, Reserve Bank and FMA, particularly post-Kofi bill, the crossovers are enormous. We're all regulating, in many respects, some of the same players. In a couple of cases, we're licensing the same players. So it's an absolute must. And I hope the industry can see that we're trying. We may not always quite yet get it right, but we are building, I talk about operationalizing things. We are building the habits that mean before we come and talk to a segment of the financial services industry about a piece of work, if we know Comcom or RB are in those firms, or maybe in those firms, or maybe doing stuff in their space, we'll have a conversation first just to say, okay, how would this work for timing? Are we trying to do too much too soon? And we're very conscious that everyone is struggling with the sheer extent of the regulatory reform that's currently, either just been passed or is about to be passed. So look, it's light years away from where it was when I started. And I know the board of the FMA for Samantha have made very clear that, continuing that close coordination, and a lot of my team now are spending significant amounts of time, particularly with the RB, but also with Comcom. And frankly, that's a good thing. And I hope it shows.
Yeah. In the last few minutes, I thought it'd be great to have a conversation about KiwiSaver, because during your tenure, KiwiSaver has just gone huge. We were tracking data. It's gone from 40 odd billion in 2017 to about 82 billion at the last count, and projected to obviously continue that hockey stick growth. I mean, what do you see? How do you see KiwiSaver transforming the way New Zealanders think about money? And we'll come to the fee value equation in a moment. But yeah, just interested in your overall sense of that.
Yeah, well, there's a whole bunch of things in there. Hopefully, it gives people some confidence that putting money into a financial product, saving money for the long term is a smart thing to be doing. And frankly, if you're not sure, exactly the extent to which you should do that or how you should do it, getting financial advice is a doubly smart thing to be doing. So I think, the growing balance is the fact it bounced back quickly after the correction, the fact that there is some pretty vocal attention on fees and value for money. Obviously, the ESG phenomenon, which is something we haven't talked about, which is another game changer compared to when I started the job. I hope that encourages a bunch of people, even frankly, if it's outside of KiwiSaver, to feel that interacting with financial products and investment products, is a smart thing to do, and to engage. So, in the early years of KiwiSaver, we were pretty disturbed by the fact that we didn't think a lot of people in KiwiSaver were, particularly engaged or particularly, aware, frankly, of what they were in. Obviously, as balances grow, and the little blip last March, April, I think would have jolted a few people out of a degree of apathy. The default provider review that the government just did, would have generated some interest there too. So what I really, really hope is that we've crossed that point of engagement, and that increasingly people will be interested in what's in their KiwiSaver, what they get out of their KiwiSaver, and who their provider is and why. That's something we've been hoping for all of this time. It feels to me we're about at that point now. And some of the balances in KiwiSaver are quite significant for people. And hopefully they're building that into a portfolio view for their retirement. And so I said when I arrived in the job that I thought, a little bit like I talked about Shares earlier and those platforms, KiwiSaver hopefully was a gateway for a lot of people to get some confidence about investing, some understanding of how investment worked. And if you're passionate on ESG, for instance, a reason to engage with your provider about what it is you want out of that. So I hope that we've gone past the point where the biggest problem with KiwiSaver was that even the people in it contributing to it didn't really know what it was or why. There's still an issue with a number of people who aren't contributing, but that goes back to the haves and have-nots, frankly, which is a bigger challenge for New Zealand. But I think KiwiSaver's been absolutely stellar for the industry and for consumers. It's performed, fantastically well in a scenario where probably a lot of people wouldn't have saved that money and wouldn't have made those returns without it. It doesn't mean there's not a bunch of things that we think, could provide better, but I frankly suspect that if you were involved in the design of KiwiSaver, and a hat tip to Michael Cullen, you'd be pretty pleased with where it is at the moment.
Yeah, and of course noting there's currently reviews on, given it's 14 years old, and just one other one on KiwiSaver. It's kind of been probably one of the contentious conversations we've had and the sector's had around this kind of focus on fees versus focus on value, and that cheapest is best versus outperformance matched to your outputs and so on. Just interested in where do you see that debate going?
Yeah, look, it's a really fair point, and we have poked at fees repeatedly. We of all people do not want to see a race to the bottom where all that's available is low cost, passive funds. There's clearly a very important place for that in the retail managed fund market and investment market, but KiwiSaver should be more than that. You want to see the range of passive and active. You want to see differently focused funds, and you want to see providers that provide a value proposition to their customers that might not be just about fees. And I mentioned ESG earlier. It's very clear to us that for some people, actually, within a reasonable bound, fees aren't really the driver. It'll be something else. And increasingly, that's what I'll put into the ESG bucket. So, I've said repeatedly in public, and so have Paul and the team, we focus on fees because we felt that given the scale of the industry, we weren't seeing enough movement on fees. But absolutely, it's about more than fees. The fees need to be, reasonable, to use that somewhat generic term. But I hope that KiwiSaver providers are thinking more about what's our overall proposition. And it doesn't mean we need to be the cheapest. In fact, some of the more expensive funds have performed incredibly well when you think of some of the KiwiSaver providers. So it's an important component of the conversation, but it's not the be-all and end-all. And I know people don't believe me when I say that, but it's true. What we're interested in is, what are you providing for the fees that people pay, and what makes you think, that's what they want, and that's good value for them. And that's a reasonably complex conversation.
Yeah. Rob, last theme before we close out. This conversation and a lot of research we've done around how New Zealanders think about risk, managing risk. So we've spoken a lot about investment risk. This kind of is about health and life risk. And it kind of seems that, we track the data and they're both reasonably flat sectors. And yet there's this yawning insurance gap or under insurance gap. I mean, how much of that do you see as a problem? And notwithstanding some of the conduct and culture stuff, how do you think we collectively shift the dial so that New Zealanders do think about insuring themselves and their lives and their health as much as they insure their houses and cars and so on?
Yeah, look, I may be off the reservation here in terms of this comment, but one of the things I perceived when I came here from the UK, which had effectively abandoned, to all intents and purposes, employers or the government providing appropriate pensions or insurance and the rest of it, and people felt very much forced to make their own decisions and go and get their own advice. My worry with KiwiSaver when I got here was that might it feed into what I see as a little bit of a sense in New Zealanders that the government will provide, the government will sort this out, and I think that potentially contributes to the lack of proactive decision making about things like insurance, which are very optional but very necessary products, and which I suspect makes it harder for the industry to persuade people to take them up. So, in the same way that I hope the engagement with KiwiSavers and the trading platforms telling people that actually there is stuff they can do themselves, and frankly there is stuff they should do themselves. Same with advice, same with insurance. We need to find a way of encouraging people that it's not impossible, particularly if you're willing to pay for advice. And these are things that you should be actively thinking about for your retirement, because it may not be the case that the government of the day can afford to provide what you want to be provided in your retirement. So, look, it's a real challenge, and it has an impact in the use of the intermediary channels, particularly around insurance, which poses all sorts of complexities in the model. But yeah, we have to keep working to convince New Zealanders that those products can be sold, honestly and fairly and transparently, and that they'll be treated the way they expect to be treated when that life event happens that's covered. And I think we just have to keep building that confidence that there's a regulator that's watching and there's an industry that cares. And I think the FSC, plays a big role in that. And I think, we should accept that it's a challenge, but we have to keep working on it.
Rob, very last question before I hand over to Tim for a vote of thanks. In 5 years' time, you leave, your tenure finishes shortly. Where do you think we will be as a sector in 5 years' time, noting the financial advice changes, Kofi, you've mentioned, various other things coming down the pipe? What's kind of your reflective and confident outlook?
Well, I shouldn't do this because I got it wrong when I started, but I would imagine in 5 years' time we'll have been through a fairly major market correction by that point. And so some of what we've been trying to do as an industry and the regulators will have been tested. But what I hope, and I think we're on the right path for, is greater confidence that the industry, when left to its own devices, is delivering stuff that is designed for the customer and operates for the customer, and that there's a regulator that's paying attention and is present in that dialogue and will respond if things go wrong, and the levels of confidence in the population that financial services and government regulators are looking out for them but aren't going to do it for them. That's where I'd hope it would get. Depending on when the Kofi bill gets passed, and I'm assured it will be, 5 years might be a little soon for it to get exactly where I'd like. But I hope what we've seen is a progression in that direction, and that dialogue with end users that we've talked about, or I've talked about here, feels more natural to a lot of people who today, just aren't in that dialogue.
Fantastic. Rob, thank you so much. I really enjoyed this conversation. There were several topics we didn't get to: financial advice, climate change, and a bunch of other really big topics. Anyway, it's been a fantastic hour. It's my pleasure now to invite Tim Williams from Chapman Tripp, who is a fantastic part of the FSC community, but in this context as sponsor, to do a vote of thanks. And Tim, over to you.
Thanks, Richard. It's a privilege to be able to thank Rob for his presentation, challenging us as always with his words of wisdom, and also have the opportunity to acknowledge Rob's tenure as CEO at the FMA. Rob and the FMA's contribution over the last 7.5 years to the financial services industry can be measured by a number of achievements. With Rob's encouragement, New Zealand did not blindly follow Australia and have its own drawn-out Australian Royal Commission, but instead took learnings from the Royal Commission and applied them with a New Zealand flavour in the conduct and culture reviews that they undertook of the banking and life insurance sectors and beyond, and used that platform to cajole the industry to adopt good procedures, policies and controls and good customer outcomes. An expression imported by Rob, I suspect, from his native United Kingdom. They've successfully navigated the introduction of a whole range of legislation, right back from the FMCA right through to FSLA and AML, and now conduct. Kofi lies ahead. They've generated trust of the financial services and the FMA as a regulator, encouraged self-disclosure and voluntary remediation through instilling, I think, an expectation of just treatment, acknowledging fairness applies to providers as well as to customers, an important theme, I believe. They've helped manage the challenges of COVID-19. I thank Rob personally for his financial advice that I shouldn't change my KiwiSaver account, and that stood me in good stead. And if I'm looking for a financial advisor, I know where to go. But he did reassure the market. I thought at the time it was a fairly risky stance because markets are unruly beasts and hard to predict. They also stepped in and adjusted timeframes for consultation and compliance, and continued to remind the market of his enduring theme that customers need to become first, and particularly emphasise the need for vulnerable customers, as you've heard him say today. He'll be leaving the FMA with a lasting legacy as it goes forward with its anticipated continual stream of new legislation to manage, expanding remit and additional budget. You'll also leave big shoes for Samantha Barras to fill. We wish her the best on the way for the future in this role. I've had the privilege of knowing Rob over the last 7.5 years, enjoyed his company at various events and functions, and listening to many of his carefully worded presentations while trying to identify points to take issue with. He's always been a class act, speaking clearly and effectively, convincing, conveying his convincing messages with a suitable emphasis for the occasion. On behalf of us all, I'd like to thank Rob and wish him well in his next role as Chief Executive of the new Venture Capital Fund. Thank you, Rob. The financial industry should be grateful for your careful stewardship of the FMA, your persuasion of and engagement with the industry throughout your tenure. Thank you, Rob. Ngā mihi. I'll now hand back the mantle to Richard to outline the regeneration program further.
Thank you, Tim, and endorse all those comments. That's awesome. Folks, that's it for today. We are going to be running these sessions over the next 6 weeks, twice a week. The Tuesday session, 3:30 to 4:30, and the Friday morning session on financial advice is coming Friday. So look out for that. Look out for all the other comms. And we're hoping to be also in person on the 6th and 7th of December, COVID permitting. So in the meantime, be well, stay safe, and if you're in Auckland, it's bottoms of resilience, and if you're outside of Auckland, enjoy the sunshine and the coffee and the cafes. And on that note, on behalf of all at the FSC, have a great afternoon. Thanks very much, and Rob, thanks again.